Mode of premium payment. This simply means how frequently are you going to pay the premium. Many of the test questions are going to assume that you're making an annual premium, which is probably typically one of the most popular choices. It is also usually the cheapest choice for premium selection because you don't have a lot of extra fees because of having to process premium bills and premium checks coming in. So the modes of premium are annually, once a year, semi-annually, twice a year, quarterly, 4 times a year, or monthly. Monthly is going to be the most expensive because you're processing these things every single month, the insurance company is. So it costs them more money. So the rate is just a little bit higher on that. And typically also monthly premiums are done through automatic bank drafts. So there's not so much, crossing in the mail kind of things. So remember, the monthly choice for mode of premium is going to be the most costly because it's going to have all the extra monthly fees to process the billing and the checks coming in every single month. So just understand that they have 4 choices and the cheapest is always going to be the annual premium. Let's talk about how when you pay the premium check affects the effective date of the policy. So you're the agent, you go out, sit down, take an application with a customer, and you collect a premium. You send the premium check and the application into home office. It's processed. They decide to accept that, and that's a good risk for the insurance company. So they will make an offer, they'll send you the policy, and then you would deliver it. The effective date in that situation is the date of the premium check, which happens to be the same date as the application date because you took the application and the premium check and they're both dated the same date. Okay? Now, you may have times where you don't take a premium check when you take the application. Sometimes there are circumstances the company would prefer that you take the application, get it sent in. Maybe you're not sure what kind of risk this person really is going to represent, so they'll ask you to not collect a premium until the underwriting process has been completed. Once the underwriting process has been completed, then the company will let you know the cost of the premium, and you take that to the client, and if they're going to accept it, then you'll let the company know. They'll issue the policy, send it to you. You go out and deliver the policy in person to the insured, and you collect the premium check at that time. Now, before you take that premium check, before you hand that policy over to them, there's an additional piece of paperwork that has to be done. It's called the Statement of Good Health or the Statement of Continuing Good Health. It's just a 1-page document typically that the insured has to sign that attests to the fact that their health has not changed since the underwriting process started. As long as they can say, yes, they're still in good health, sign off on it, you get that signed form back, they give you the premium check, you hand them the policy. So you take that statement of continued good health that is now signed by the client, they write out a premium check, hand it to you, you hand them the policy. They just wrote the date on that check. The date you're delivering the policy, that's the effective date when you're picking up the check when you deliver the policy. Okay, so it's the delivery date, it's also the date they write the check to you. That's when that policy is effective. The coverage goes into force. So that's policy delivery. Policy backdating. When do you use backdating? It's something that's a process that you can use to help save age, because if someone is younger than what you thought they were, they're going to have a cheaper premium, right? So you can backdate a policy in order to save their younger age. So it's going to lower their premium. Typically, you cannot backdate a policy more than 6 months. Okay, so know that. And premiums must be paid from the effective date of coverage. So if you backdate 6 months, the effective date of that policy is going to be that date 6 months in the past, which means the next premium is going to come due 6 months in the future. So always be aware when you backdate, it means the next premium check is going to be coming due. If it's an annual, a lot quicker than a year because of the backdating. But you've saved the client sometimes quite a bit of money because you were able to backdate far enough they could keep their 1 year younger age. It's going to have an impact on the premium, because the younger you are, the cheaper the premium is. So no more than 6 months for backdating.